Hello, my name is Elliott. I'm editor of Personal Finance as well as the Energy Strategist. Today I want to talk a little bit about the general macroeconomic outlook as well as the outlook for the market for the S&P 500 and also some of the sectors I like for the end-of-year rally that I see coming. Generally speaking, what we've seen this year is a real roller coaster ride in expectations. At the beginning of 2010, generally speaking, the economic data was coming in quite a bit better than expected. We actually saw some pretty solid jobs growth numbers back in March and April, and that led a lot of economists and investors to kind of believe that maybe the U.S. was seeing a sort of V-shaped recovery, similar to the recoveries we've seen from prior recessions. The reality was that that just wasn't the case. The U.S. is, as I've said for a long time, is seeing a recovery, but it's a very cyclical, sort of lumpy recovery from the deep downturn of 2007 through 2009. It's not the sort of V-shaped recovery we've seen in from prior downturns. As a result, as we hit the late April, early May period, and certainly into June, we began seeing a notable softening of U.S. economic data. This also coincided with a period of debt market turmoil stemming primarily from the European Union and in particular the peripheral economies in Europe, mainly Greece, Ireland, Spain, Portugal. Now, what this meant was that we had what I like to call a growth scare. Investors went from being sort of over-optimistic about the prospects for U.S. economic recovery in March to predicting a double dip really in May, June, July. The reality has pretty much always been the same. We saw what's traditionally called a soft patch for the U.S. economic recovery, started in May, really lasted through August. Now we're getting yet another turn. Starting in September, we began to see, again, a notable firming in economic data. Now, part of it was a result of expectations coming down. As a result of the softening we saw over the summer, a lot of analysts simply brought down their expectations for economic growth, the unemployment rate, the potential for growth in various sectors of the economy. Pretty much any economic data point you can think of was revised lower, more negative. As a result, it's been pretty easy for the numbers to beat those expectations. In addition to that, we have actually seen a notable firming. Numbers like ISM, the Institute for Supply Management figures, show continued growth in both the manufacturing and, importantly, the services sector of the U.S. economy. Now, growth rates have slowed notably from early this year. That's not a big surprise. We saw inventory adjustments in the first half of 2010 really drove a pretty sharp increase in growth. It's normal for this stage of a recovery for growth rates to come down and moderate a little bit, and that's exactly what we've seen. At the same time, we're also seeing signs of what's called a soft landing in countries like China. China's obviously been trying to slow its economy since the beginning of 2010. They've successfully done that. Growth rates have come down from very strong rates of over 11–12% at the beginning of the year, all the way down to sort of that 8–9% sort of target zone that the Chinese government's been holding for a long period of time. And lately we've seen, again, a little bit of firming of the data there, indicating that the worst of the slowdown is past. The Chinese government has engineered exactly what they wanted, a soft landing, and we're now actually seeing a little bit of a firming up or continued growth at a high rate for China. This is exactly why we saw the strongest gains for the stock market for the S&P 500 in September since 1939. So 71 years really since we've seen gains of that magnitude in the month of September, traditionally not a strong month for stocks. It was simply the idea that there could be a double dip recession coming off the table. As I've said all along, a double dip has never really been a likely scenario. What we're going to see is continued slow, lumpy economic growth in your developed countries and in your developing countries, emerging markets, China, India, etc. I think we're going to continue to see very, very strong economic growth. This is really setting us up for a year-end rally in the stock market. The excess bearishness that permeated stocks back in June, July, and August is being baked out of the market right now. I think that's going to produce a little bit more upside. The other point is the earnings season, which is upcoming for the United States, really isn't much of a bar to clear. As a result of the softening in economic data over the summer, analysts really didn't bump up their expectations for third quarter earnings. So I think a lot of companies are going to be able to beat expectations, and probably by a large margin. It's really amazing that analysts didn't push up their estimates more in light of how strong second quarter earnings season was. Adding sort of gasoline to those fires is Fed policy, monetary policy. What we're setting up for is yet another global round of quantitative easing, very loose monetary policy, essentially injecting cash directly into the financial system. Japan, just a few days ago, announced the purchase of $60 billion worth of securities. It's primarily going to be government bonds, but also corporate bonds and REITs, Japanese REITs, real estate investment trusts. The U.S. policymakers have already kind of embarked on QE, sort of tentative QE, quantitative easing, by reinvesting proceeds from bonds that they bought during the financial crisis. Now we're going to see sort of real QE because we've been hinted by a number of Fed members that they're actually going to start outright purchases of bonds and other securities from financial institutions. Again, quantitative easing, easing up of money, pushing down interest rates, really flooding the economy with cash. We're also likely to see some of that potentially from some European economies, in particular the UK. And even some of the countries that have been seeing pretty strong economic growth, like Australia, have foregone expected interest rate hikes. In other words, instead of hiking rates as expected, they've kind of kept rates steady, even though they are seeing some stoking up of inflationary pressures in those countries and also an acceleration of growth. So what we're really seeing is that even though signs are emerging that the U.S. and other economies around the world are getting better, the Fed and other central banks are really going to throw gasoline on the fire and really hyper-accelerate things with quantitative easing and very easy money policy. This really sets us up for what could be an explosive year-end rally. Obviously, I have longer-term, very deep longer-term concerns about the after effects of all this easy money. But for the next 3 or 4 months, what it means is we probably will see most asset classes go higher in tandem. How do we play this? I think some of the primary beneficiaries of this growth are going to be your global commodities, in particular like oil and coal, as well as generally cyclically focused stocks, stocks in industries like energy, like industrials, and basic materials. These companies are going to do quite well. They're the most exposed to reacceleration in economic growth, and they're going to see inflows simply because of all the money sloshing around out there. So in summary, I think that we've avoided a double-dip recession in the United States. What we have is continued slow, lumpy growth going forward. At the same time, very easy monetary policy is likely to kind of stoke stocks and stoke other asset classes like commodities. Focus your investing attention on energy, and in particular coal and oil-focused stocks, well as stocks in cyclical sectors like industrials and basic materials. Thank you very much.